And I want you to be aware. I have it written as the book does it, but it's really odd to me because then in some of the problems that are presented in the Connect homework, it uses a different method, which is okay, but we just need to make sure we have the right, the right footing and we understand what we're doing. So when it comes to sales returns are just another sort of risk that we will not receive money. We will not collect the revenue, or we won't recognize. We recognize some revenue when we delivered our good, but that if that good ultimately gets returned, then the revenue is overstated. Because if I sold something for $10, debited cash, credited sales revenue, and then it gets returned, well, it's basically, I should not have recorded a revenue for $10 because now it's returned and I have to give that cash back. And because sales return policies can extend for a generous window in some cases, 3 months, maybe even sometimes longer, we have to be careful again by recognizing the cost of generating a revenue. One of the things that can make people more likely to buy our product is if they're dissatisfied, they can return it. Hence, sales returns and generous sales returns policy can help us create additional sales and record additional revenue. But we have to recognize the potential cost of the return in the period that we recorded that revenue. So again, we're appealing a lot to the matching principle here. And we're also just dealing with a common transaction that occurs because most companies have some sort of a return policy. There's a couple of caveats about how we or when we can actually invoke the accounting for sales returns. If we cannot reasonably estimate the amount of sales that will be returns, so maybe it's a new product line, maybe we're a new company, we don't have the historical data to project how much of our sales will result in returns. Then if we're offering sales returns, we must wait until the return window expires to record revenue. So if you're in that case, we make a sale on January 1st, right? And we don't have any reliable return probability for this product, and we have a 3-month window of return, we have to wait until April 1st to recognize the revenue on that, right? We would recognize the cash right away because maybe they paid us cash, we debit cash, but until we've honored the return window and they have not returned it, it would be a deferred revenue. Returns that are immaterial may be recorded as they occur with no estimates in the future. And that's just because of the materiality constraint. Remember, the materiality constraint allows deviation from GAAP. If the transaction is immaterial, which means that it would not change a decision for a financial statement user. So maybe we only experience of the $1 billion of sales our company makes, only 100,000, maybe even just $10,000 of returns occur, then at that point, it's just a blip on the radar. It really isn't a big factor. So we don't have to go through the whole process of making an end of period adjusting entry. So the way that I learned it, so this is what your book presents for everything. And I kind of twitch about it because this is not usually how companies report allowance sales returns when they estimate sales returns. They do it for cash. I 100% agree that if we have a cash-based sales return, so up to this point we were talking about selling things on credit, but if our sale is made with cash, then 100% this is how it's done, right? At the point of sale, I debit cash, I credit sales revenue. Right? Nothing new there. In order to account for any still existing returns at the end of the period, I would make an estimate of everything that hasn't been returned yet, but is likely to be returned based on my estimate. I would debit sales returns and credit refund liability. Sales returns reduces net income. It is a contra revenue account. So it's like sales discounts. It's another thing that reduces my overall sales revenue as a contra account. Sales revenue is a credit-based account. Credits increase it. So in the case of sales return, since it's contra, debits increase it and credits decrease it. When I report sales revenue on the income statement, it is reduced by sales returns. Hence, a lot of the examples you see will say sales revenue net. That means it's net of sales returns and net of any cash discounts that we offer for prompt payment. The refund liability is indeed a liability. It would be a current liability in most cases. And that's how that's accounted for with a cash-based sell. Now, with credit-based accounting, this is what I see in the financial statements that I've looked at. Not a credit to refund liability like the book seems to say is universally done for both cash and credit-based sales, but instead another allowance account, an allowance for sales returns. And the sales returns are the exact same. They reduce net income. There's still a contra revenue account that reduces sales revenue. The only difference is instead of crediting a liability account when it's a credit sale, right? Debit accounts receivable, credit sales revenue. We have a credit sale going on. We credit allowance for sales returns, which is just another contra asset account, like the allowance for doubtful accounts. The only thing you have to be very careful of is there's a single word of difference between this and sales returns, and that's just the allowance part. Well, two words, allowance for, but the allowance makes it an estimate account, right? So this is what I would do at the end of the period in order to record any outstanding returns that I believe will happen that have not yet happened during the period. I just go, little verbiage. Sales returns under both types of estimations here and here is not a direct expense, but a contra revenue. It is closed because it's a revenue still. Even though it's contra, it's still an income statement account that has to be closed at the end of the period. It reduces sales revenue that's reported on the income statement. Remember that the role of any contra account is to reduce the value of its parent account when it's reported on a financial statement. And the only distinction between the two methods, whether it's a cash-based sell or a credit-based sell, is whether I credit a liability or whether I credit an asset. So that's the estimation. Those two things up here. This is what I estimate at the end of the period. And I kept saying, this is the estimate of any returns we believe are still outstanding that did not occur during the year, did not occur during the year. So when things happen during the year, when we actually have a return, then we want to debit sales returns and credit accounts receivable, or debit sales returns and credit cash. The only caveat to this is I should add to this actual returns when the return occurs during the period and refund liability allowance for sales returns accounts are zeroed out. And what I mean by that is, if I have something, if I have an amount that is in my allowance for sales returns, let's say I got $10 in here. That is my beginning balance from the prior period. And during the period, $15 of sales returns occur. Okay. My move is to first reduce this to 0. And then charge any remaining amount as sales returns for this period. So I would have two entries. First, I would debit my allowance for sales returns for those $10. And then I would credit accounts receivable for $10. That gets me to 0. But I have $5 more of sales returns that are happening now, according to my estimate. Now, these are based on sales that are being made during this period. Because this $10 holdover were items that came about from the prior period. This was my estimate based on all the sales I made in the prior period. I still have $10 remaining that could affect my future collections. Then the first ones that come in, if they're in that window, would reduce my allowance for sales returns to 0. But then after that, any additional ones must be coming in from this period and therefore get charged to sales returns during this period. And it is, again, an instance of the matching principle. I only want to reduce net income for those returns that happened during this period. So for returns from sales made during this period. If things from the prior period that were sold in the prior period are being returned, there should be no net income effect. And there isn't, because this $10 is getting debited from the allowance for sales returns. That's just increasing one of my asset accounts. Debited to my contra asset because sales were made in the prior period. And this $10 was put there by the estimate that was made in the prior period. That is, I debited sales returns and credited my allowance for sales returns to put that $10 there at the end of the prior period. If I debited sales returns and credited my ASR for $10, that means I already assessed a net income effect for these $10 that had to be returned. If I just debited sales returns for all 15, then I've double counted. I've double counted $10 of those sales. Not only did I reduce net income $10 in the prior period when I made this estimate, but I also, if I record this as a debit to sales returns of $15, then I will account that $10 against net income during this period as well. So you have to be a little careful when you have an outstanding balance in either your allowance for sales returns or your refund liability, whether it's cash or credit-based sales. It might be the case that you have overestimated returns. So maybe, for example, in this scenario where I had a beginning balance of $10, that I thought there was still going to be $10 of merchandise coming in. But let's say that our return window is 1 month. So even if our returns are based on December sales, even if it's the $10 of things we sold in December that we think might be coming in this period in January, if we have none of that merchandise returned in January, then we can get rid of this estimate because that did not happen. When that occurs, all we do is reverse the entry. We debit the allowance for sales returns to get rid of the balance. We debit it by $10, it zeroes it out. And we credit sales returns in this period because we're now correcting that estimate. Because we charged $10 of sales returns to put that $10 here, but it's no longer necessary, so we can credit it back. It did not actually happen. Same idea with the refund liability. I want to work through one problem just so we can see it all in action with this Thor ink. There is a note that basically all of this, it's a layer of additional detail, is that when I predict sales returns, if you think about for example, if I sold a good here, I'm also crediting cost of goods, debiting cost of goods sold and crediting inventory. And if I'm going to predict that some of this is coming back, then I have to debit my inventory and credit cost of goods sold, because if that if there is a sales return, it's going to increase my inventory and reduce my cost of goods sold. That's just a note for, like, everything that gets affected by this. I'll revisit that idea when we talk about inventory, but just as an FYI. Most of the assignments say, ignore the cost of goods sold effect. All right, so let's look at this problem real quick and then we'll wrap up. Thor offers a 3-month return window on merchandise that it sells on credit. Assume that in the first quarter, Thor made $374, $320 of credit sales. Thor records estimate, or Thor's records estimate a 4% likelihood that all sales will be returned within a 3-month window. During the month, they recorded $11,753 of returns. Provide the journal entries for the sales returns, as well as the quarter end adjustment that would be required. So the credit sales, not a big deal. Debit accounts receivable. Credit my sales revenue. But because of the sales returns, this is not going to be an accurate portrayal of the real revenue I want to record for that period. It's going to overstate it, because if they're returning it, I don't get to record the revenue. During the month, I don't have it worked in here, but I want to just show you how it would work. Let's assume the allowance for sales returns beginning balance is $5,000. So I have an ASR that has a beginning balance that says I expect some of the stuff from the prior quarter to be returned still, and the window has not closed on those. So they are still potential returns coming in. So it recorded $11,753 of returns. So people brought stuff back and said, or sent inventory back and said, I don't want it. Then that means that my actual sales returns are going to be journaled as follows. Because we have a non-zero allowance, the first 5,000 are going to come from the allowance for sales returns. And I will credit accounts receivable for those. And again, I want to get rid of this first, because in order for that $5,000 to have gotten there, I debited sales returns and credited my ASR. So the $5,000 of the net income effect already was recorded in the prior period. I don't want to double count that amount. I want to reduce this down to 0 first. Now, everything beyond that is going to come as a reduction to my current period net income, because I'm going to debit sales returns for the remaining amount, 6,753. And still the customer's account is now nullified because they don't owe us for their returned merchandise. So that's all that would happen during the period. Now, at the end of the period, I have to determine my adjusting entry. So we're at the end of the quarter and we have to think, all right, is there any additional sales that will be coming back as returns? Well, it says that they estimate 4% likelihood or 4% of my sales are going to end up as returns. So 4% of $374,320 will be returns, which gives me $14,972.80 if we're being exact. Now, if that is the total returns that are estimated based on this period's sales, you might initially think, oh, I want to debit and credit accounts for that full amount. But we've already had some returns that have come in that are coming in from this period sales. How do I know they're this period sales, or that's this period that the sales were made that are being returned? Because I've exhausted my allowance from the prior period. It only said 5,000 were going to come in. I've already accounted for those 5,000. That's zeroed out. The remainder is then assumed to have happened in this period. So rather than thinking that all of these are outstanding still at the end of the period, I've already recorded 6,753 of those. So I subtract that out. 8,219.8 is what remains. This is what I still think may come into, oops, wrong one. What still may come back from this period sales. Sales returns 8,219.8. Credit my allowance for sales returns the same amount. So you really got to think kind of deeply. You can't just memorize the journal entries anymore. I know that probably worked in intro, won't work here any longer. You got to think it through. You got to really think of the transaction. You know, why is it that I treat this differently than this? And you have to give yourself that intuition. And I know, again, it's not the most pleasant feeling at first when your mind's twisting and it's like, well, why the hell is this different? People are just bringing crap back. It shouldn't matter. But it matters in terms of this 5,000, the income effect was already felt in the prior period. We don't need to have another net income effect this period. So we go to a different place where there will not be an income effect when we debit it and we credit accounts receivable. However, these guys are the returns from this period's sales. And so once you start connecting those ideas, I assure you that even though it hurts your head, even though it takes longer than memorizing, it will pay off in the future, because then you've expanded your mind's capacity to think these things through. And, you know, accounting in a lot of ways is just same story, different context, right? The counts change, whether it's an asset or a liability changes, but overall, it's the same, you know, second verse, same as the first sort of syndrome. So yeah, thank you guys for coming today. If you have any questions, I'll hang around for a bit. If not, have a beautiful weekend. Work on assignment 8. It is rather challenging, and that will really sharpen your skills and get you ready for the test.